What is Yellen doing here? Is she just keeping the Fed's options open? Because we've had so many different policymakers with hawkish views, and then she comes out and says, look, we could let the economy run hot.
Well, this is, of course, the message that she gave very clearly in September. So it was the new message of the FOMC press conference in September, that the economy had room to run. And, of course, since then we've had a payrolls report which has suggested that this labour supply really is growing at a continued and an accelerated pace. So that makes it a little bit awkward for her. I suspect at this stage she is just keeping options open. I think there's not been any strong guidance yet that the market is incorrectly pricing the probability of a rate hike at the end of the year. We certainly still expect to see a December rate hike come through. But the next couple of payrolls reports are going to be interesting. The point is, for Yellen, she has a very split committee. There are a number of people telling her that she should keep rates low for a long period of time, but there's a distinct member that really wants to see rates start to rise more quickly than that. And we think that what she'll probably do is talk about a gradual increase, a gradual leaving some stimulus in the economy, but gradually withdrawing that stimulus.
And you're still expecting that rate hike to come in December, as the market is, if you look at WIRP?
Yeah, very much so. Yeah, we think it's, I mean, we've thought for a long time that they wouldn't be able to move before the election, but the economy's momentum was sufficient to see them start to withdraw what they perceive as still some stimulus in the economy at that point. What will be key is after the November meeting. So we have no expectation for them to move rates in November, but the communication after them will be very interesting, because that's when the committee will have the final chance to say, OK, how are we going to signal to the markets over the next 6 weeks about what we intend to do. So if we see a significant change in communication strategy after that, if there's a change in the FOMC statement at that meeting, that's when you might start to double check whether or not December's coming through. But for now, we certainly expect to see a rate hike at that time.
You've, really emphasised how data dependent the Fed is. Is there really, looking at the economic data, anything that's going to be that different between now and November, and then between November and December?
One hopes not. Obviously, we get 2 more payrolls reports, we get 2 more ISMs. So the momentum at the moment of the economy seems to be pretty strong. We certainly expect to see the second half of this year post much faster growth than we saw over the first half of the year. And that's going to encourage the Fed that they really do need to start moving policy a little bit further forwards. But, as we say, this new trend of a very fast expansion of the labour supply is something the Fed's been hoping about for years. I mean, back in 2014, the Fed was talking about hoping to draw people back into the labour market. So they're finally seeing that come through, and they don't want to choke it off too soon. But I think there is a careful balance coming through, and Fed's credibility about messaging is also something. I think they've put a lot of emphasis on wanting one rate hike this year, and I think it'll take a lot to shift that now.
I just want to show you this chart. We did bring it up earlier. It's basically showing the yield curve steepening the most since March on those expectations of higher inflation. Of course, those 30-year yields are most sensitive to inflation expectations. We have been seeing the break-even rates move higher. I'm just looking at ILBE on the Bloomberg, the break-even 10-year at 1.67% at the moment. What are your thoughts on inflation? Are you expecting that to keep sort of running higher, and when do you expect it to actually reach the Fed's, their 2% target?
Well, we're looking at CPI inflation picking up quite markedly over the next couple of quarters. I mean, obviously, what we're seeing here is not only the base effect, the oil price base effect from last year coming out, but we're starting to see some renewed pressure coming through in oil prices. So that helps to push the headline level higher. So we expect some normalisation there, but we also expect to see core inflation picking up. Unit labour costs are actually reasonably firm. There's some signs that we're seeing a pickup in wages, but productivity growth is still very subdued. So unit labour costs are arguing for a higher level of inflation as well. Of course, when it comes to inflation expectations, they're very closely mirrored the movements in oil prices, and we've been waiting for some time to see them catch up to the normalisation in oil prices that we've seen over the last couple of months. And that seems to finally be happening now. So that gives the Fed some confidence that their mandate is within sort of the conceivable future.
And with the dollar, what are your expectations? Do you think we're going to see sort of strength at the end of the year if we do get that hike, but then perhaps a bit of a limit to dollar gains as we don't see, a very speedy hiking cycle? And what does that mean for the economy?
Yeah, I mean, absolutely, we think that. And certainly we've seen quite a sharp move in dollar come through over this last month or so, as markets have more confidently predicted a rate hike coming through at year end. So we suspect that a lot of that is being, if you like, front runners already being priced into the market. I think when the Fed does tighten, whenever that may be, it will continue with its mantra of a gradual appreciation, and perhaps part of that is going to be to allow the economy to run hot. So markets will be very reassured that the Fed isn't going to be tightening rates aggressively over the next few quarters, and that should limit the upside to the dollar from here, which hopefully means that the economy as a whole doesn't have the harsh headwinds that it faced at the start of this year after a very strong and long period of appreciation from the dollar.
And does that mean that other parts of the world as well won't necessarily feel the harsh headwinds of a stronger dollar? I mean, China, for example.
Yes, it should help. I mean, I think that the very sharp appreciation that we saw in the dollar from mid-2013 through to the end of 2015 caused a lot of stresses in a lot of different areas, and I think most people will be keen to avoid that. Now, obviously, the Fed only has so much leeway as to how much it can control FX markets, but I think its suggestion that we'll only see this gradual pace should limit the appreciation, which minimises the impact for the dollar, but more broadly elsewhere as well.